Hi friends, welcome to A to Z Learning channel. This is the tax time. Many of you must be getting ready to file your income tax return for the last financial year. Many of you must also be in the process of calculating your advance tax liability, which is due on 15th of September. So, so the tax preparation is in the air, and I'm sure you all are thinking about what are the various what are the various ways the tax is calculated. So today in this video, we are going to be helping you understand how the capital gain tax works. Is in a sense will help you understand basically three parts. The first, what are the capital assets? What is the long-term capital gain versus short-term capital gain? And last but not least, what are the applicable tax rates on the capital gains? So if you are interested in this area of tax knowledge, then this is an important video for you. Please stay with us until the end of the video because you don't want to be missing out something that we are going to be covering here, something that's going to be very useful for you to better understand all around capital gain taxation in India. So without any further delay, let's start our video. So as I said, the first question that we will help you understand is what are the capital assets? Under the India Income Tax Act, capital assets are clearly defined. Just for example, I'll share what are the kind of typical capital assets that are defined under the India Income Tax Act. The land, buildings, flat, house, shares, listed or non-listed, mutual fund units, they're all are capital assets and are clearly defined under the Income Tax Act. There are some exceptions, some exclusions here. For example, we all at some point in time buy a vehicle, whether it's a scooter or motorcycle or a car. Those are not classed as capital assets. So when you sell those assets, those vehicles, and make a profit out of it, then you are not subject to any taxation. Usually, you kind of assume that vehicle by the time you kind of buy and sell, there is usually a depreciation. It's highly unlikely that you will have appreciation by selling your vehicle, but there are some antique I guess old vehicles which with time could increase in their value as well, but cars are excluded from the capital asset list. Similarly, furniture, you could buy or sell furniture. Again, by design, the tax authorities believe that these are depreciable assets, and that's the reason they have excluded these items from the definition of capital assets. So then question comes, having understood what a typical capital asset is, any appreciation or gain at the time of sale of these capital asset is either classified as long-term capital gain or short-term capital gain, and those gains are subject to long-term or short-term capital gain taxes. Okay, so then the question comes is that what is the difference between long-term and short-term capital gain? How do you determine what is long-term capital gain versus short-term capital gain? It's simple. The way to kind of understand is that it is all a matter of how long you've held those capital assets. Based on the period for which it is held, it could fall in the category of a short-term capital asset, short-term capital gain versus long-term capital gain. To better understand, we've got this table which is on your screen right now, where we have got three columns, condition, and whether it's a short term or long term. So first of all, the way we have defined, we've categorized is basically let's group all the capital assets into three broad categories. First of all, let's talk about any equity oriented fund units like mutual funds, equity mutual funds, by the way, huh? And any listed shares, any share company share that is listed on the either Bombay Stock Exchange or National Stock Exchange will be in the first category. So if you have capital assets of equity mutual funds or listed shares, and you have held that for less than 12 months before you have sold it and have had some gain, then anything that is held for less than 12 months, 1 year, is short term. If it is held for 12 months or over, then it is considered long term. Understood? The second type of assets are, say, unlisted shares of the company. So there are many companies which are not listed on the National Stock Exchange or Bombay Stock Exchange, but they are periodically sold and exchanged between various parties. Um, so for example, venture capital funds, they periodically kind of pick up shares in some unlisted companies, some startup companies, or property for that matter, or flat. In these cases, if the capital asset, if the property or unlisted shares have been held for less than 24 months or 2 years for simplicity, then it is short term. Otherwise, if it is held for more than 2 years or 24 months, then it is called long term. And then the third category is basically for example, the debt mutual funds or any other capital asset, right? You have to hold it for minimum period of 36 months to get into a long-term capital gain. So if you hold debt mutual funds or any other capital asset for over 3 years, then your any gain or appreciation that you have realized at the time of selling those capital asset, that will be subject to long-term capital gain. If you have held that for less than 3 years or 36 months, then the gain will be classed as short-term capital gain. I hope it makes sense. Now let's move forward and talk about what are the applicable tax rates. But before I jump to that, I would really urge you to please press the like button if you're liking the content. If you have any comment on this, if any of these things are less clear to you, let us know through the comments your questions, your comments on this video. Okay, let's now move to the last and final section, which is what are the applicable tax rates. So we now know what the capital asset is. We also know when the gain or appreciation on these capital asset is classified as short-term capital gain versus long-term capital gain. So then the question comes is that what is this FAF all about? Is there any difference in terms of the applicable tax rate between long-term versus short-term? Answer is absolutely yes. Long-term capital gain tax is subject to concessional or lower tax rate compared to short-term capital gain tax. So now let's understand what is that difference. So the table on your screen is we have set out all the detail here. So if we pick up the long-term capital gain tax first, broadly we need to kind of classify or group the long-term capital gain tax into two categories. First is if it is happening as a result of sale of equity mutual funds or listed equity shares, then the tax rate for first 1 lakh rupees of gain, it is 0. If your gain in a given financial year is more than 1 lakh by selling equity mutual funds or listed equity shares, then that long-term capital gain, which is higher than 1 lakh, will be subject to 10% tax. Okay. If the long-term capital gain tax is coming from selling any other capital asset, which is not mutual fund, equity mutual fund or equity share, then the long-term capital gain tax on all those gain will be 20%. Still, it is a lower tax than the typical tax rate that people pay. Okay, understood? So if it's If it's a long-term capital gain is from the equity, mutual fund or listed share stock, first 1 lakh is free of tax. Above 1 lakh, you pay 10% long-term capital gain tax. If long-term capital gain tax is coming from any other capital asset, means other than equity mutual fund and equity shares, then it will be 20% and there is no free gain. Now let's move to the second part, which is short-term capital gain tax. The way to understand is that if the capital asset that you have sold, which was held for a period that has triggered it to be short-term capital gain tax, then you need to kind of first answer whether the asset that you have sold was subject to security transaction tax or not. If the answer is that yes, the asset was subject to security transaction tax, then your short-term capital gain tax will be 15%, lower but higher than the long-term capital gain tax, because usually security transaction tax is applicable on your listed equity shares. So long-term capital gain tax, as we know, first 1 lakh was free and after that 10%. But if it's a short term, which means you have held it for less than 12 months, but you have paid clearly security transaction tax on that, still your tax liability is 15%. But if you have sold a capital asset which was not subject to security transaction tax, then short-term capital gain is subject to your marginal income tax rate. So if you're a highest taxpayer in India, then you'll pay the highest tax rate with all the cess and all those sort of things. So it could be as high as 35%. So I hope you've understood the difference between long-term capital gain and the short-term capital gain, and also understood what are the kind of applicable tax rates on these gains. Hope this quick run through the capital gain taxation has been helpful. We would look forward to your comments to see whether our content is meeting your expectation, and also let us know if you have any suggestion in terms of anything important that you have noticed missing or any particular area that you would want us to kind of dive deeper, then also let us know. The last thing to kind of say, it's our marketing effort, I guess. If we would urge you, if you like the content of this video, then please press the like button and share it amongst your friends and family. If you've not subscribed our channel A to Z Learning as yet, then please subscribe and become part of our viewers family. Thank you so much for watching our video.